Institutional Securities, joining us on the show. And hi, sir, thank you for your time today. Give us a sense of where you have, of what your reading rather is on the way the market has been reacting over the last couple of months, especially since we've seen a little bit of recovery, if you could call it that, from the kind of consolidation that we've been seeing over the last 6 to 8 months. But once again, anything that we're seeing is not sticking in terms of the gains we're seeing. Your take on that, and where do you think overall the market could head from here?
Okay. Firstly, good afternoon. Thank you for having me on your show. Now, on the markets, see, one cannot run away from from the fact that the markets are expensive. The market is trading almost at 23 or 24 times 1 year forward, which is on the expensive side. It is almost like one standard deviation away from the mean. Now, given this context, you could possibly justify these valuations if the market was giving you 15% or 20% kind of EPS growth. We started the last year, which is FY25, with an EPS growth expectation of almost 15%. We ended up with something like 3.4% kind of growth. Now, in the current year also, we started with almost 15% kind of growth expectations. Currently, that has got chopped down to roughly around 7%. Given this context, it is very hard to expect more than modest or flattish returns for the current year. I think even for the last 12 months, the market has not given any kind of returns. So we personally believe that there isn't too much of money to be made, at least in the headline indices, because all of them are very expensive. There might be individual stocks here and there where you could be making returns. But yes, it is a fact that the market is on the expensive side, and probabilistically, it is very difficult to make returns in this kind of a market.
Mr. Subramanian, hi, this is Harsha. Let me get a sense. So are you not penciling in an earnings re-rating maybe over the next few quarters? Your thesis seems to suggest that it's going to be a slower revival of growth. Is that what you're suggesting or penciling in?
Yeah, precisely. That is what we are trying to communicate here. Let me take an example of banks, for example. I think in the first quarter, banks' core operating profit actually declined YOY. In the second quarter, again, core operating profit for banks are going to decline in the second quarter also. But yes, banks have given slightly better results than what most people expected. So earnings have got revised up. Similarly, third quarter again, while on a quarter-on-quarter basis, the EPS growth will be maybe a little less of a decline, and fourth quarter you will see an improvement. But these are already factored in the numbers. I mean, it's not like numbers for the index as a whole are getting revised up. And please remember, banks are almost 30% of the index. So unless the needle swings on banks, it is very difficult to have meaningful EPS growth, double-digit kind of EPS growth, which is definitely possible next year. But this year, it is highly unlikely.
Okay, and therefore, if the earnings revival doesn't come, you will likely not see returns also correspondingly on the index. That's basically your thesis. I get your point, sir.
Yes.
Also, therefore, give me a sense. Which are the pockets where you feel that the market is overheated or has run away ahead of itself? Where is the largest risk at this point, in your opinion?
To some extent, I think, for example, pharma looks expensive to us. Also, beyond pharma, I think even, let's say, NBFCs look very expensive. While NBFCs have delivered very decent numbers, I don't think we have too much valuation comfort in these two sectors. Coming to pharma and NBFCs, these are two sectors where they have run up a little too much.
Take on some of those sectors, but Mr. Balasubramaniam, on the other side, which would be some of the sectors that are complete avoids right now, either on the back of valuations or earnings have been lagging? Anything that you would avoid at the moment?
See, I wouldn't say avoid, but I'll highlight to you the sectors which we are underweight. Like I told you, we are underweight on pharma, we are underweight on infrastructure, we are underweight on defense. We are more or less neutral on metals. We are not positive on metals. And besides this, I think these would be infrastructure, industrial, sports, defense, power utilities. these would be all our underweights in the broader Nifty.
Fair point. Venkatesh, now that there's one end of the market which could get impacted if oil prices at all flutter around, and there's plenty of hypothesis which is playing out here, because you've got a couple of companies in Russia which the US has sanctioned to some extent, and you could see further sanctions also come through, as a result of which we've already seen a bit of a spike on oil prices. Nothing material yet, but if that were to play out, a very, very real risk for OMCs and that basket, if at all any. And would you then thereafter be tempted to play something like an ONGC of sorts? Is that maybe the one way to play it?
Okay. Now, interestingly, I think what I believe has happened is on Wednesday, the United States of America has put sanctions on some of the Russian oil companies like Lukoil and Rosneft. And anyone who gets oil from them, you could potentially see secondary sanctions. So what we understand at this point is Indian refiners are scrambling now to kind of find fresh oil contracts if they have to cut back on Russian oil. Now, I believe that even crude prices have gone up by roughly around $5 per barrel. So clearly a risk for the oil marketing companies, like you mentioned. I think it at the margin, it will have a negative impact on somebody like Reliance Industries also. But yes, on the flip side, it does benefit somebody like Oil India and ONGC. And between Oil India and ONGC, we have a preference for Oil India. So if you can build a credible thesis that oil prices will go up from here meaningfully, definitely Oil India and ONGC come into play.
That's your take when it comes to this entire oil issue that we're seeing panning out right now. But Mr. Balasubramaniam, let's refocus once again to domestics and talk about earnings. And particularly, let's talk about IT, the large cap IT earnings that we've seen so far. They've not been all that bad, as much as the street was penciling in. Do you believe that there is now renewed optimism in this sector? And do you believe that this little bit of positivity that we're seeing is here to stay?
See, when it comes to IT sector, what we have noticed is all the numbers have been slightly ahead of expectations. Now, but we would like to warn people that don't get overexcited by this, because what you see, large cap IT stocks have gone up by almost 5% on the back of that, and mid cap IT has run up by almost 10 to 15%. So, which basically means that whatever positives came to the results have already got priced in. Now, when I look at large cap IT sector as a basket, it is very difficult to imagine large cap IT growing at more than 5%. And why is that? Because of the deflationary impact of AI. It will be very hard for IT sector, at least large cap IT, to grow meaningfully. There will be a few exceptions to the rule. For example, in mid cap IT, somebody like Coforge might grow at 15 to 20%. So that might grow faster, but large cap IT, very difficult to see them growing at more than 5%. Now, look at it this way. Nifty trading at 22, 23, 24 times, expected to give you 7% kind of EPS growth. IT sector trading at maybe between 20 to 21, 22 times, it's going to give you 5% EPS growth. I would say that you should be neutral the sector, not get too excited when it comes to IT. There are also some risks on the horizon, which is not priced in, or which at this point in time, we don't expect that will play out, which is, for example, the Hire Act, that any kind of outsourcing could actually end up having duties. It doesn't seem logical at this point in time, but at least when it comes to Trump tariffs over the last 6 months, nothing which has panned out seem logical. So I would logically tell you that be prepared for the illogical things happening in this market when it comes to tariffs. So you can't assume that, one week we hear that India and US are going to are reaching an understanding and the tariff problem will be solved. We'll go from 50% to 50% tariff to 15% tariff. The next week we hear news that the tariff talks are not going well. So you're not too really sure what exactly is happening. In this context, we would suggest focus on domestic plays focus on domestic consumption. Domestic consumption is doing phenomenally well. Don't ignore auto. The run up in auto numbers getting upgraded have just started.
So what? So okay, domestic consumption and auto is what you seem to be liking, Venkatesh.
Yeah.
Okay, and so let's talk about auto. The run up has been stupendous, right? You've had a fabulous last couple of months, especially from the middle of August. What is the basket which you feel will outperform at this point? Because pretty much everything you've owned has run up now. So now, you'll have to deliver in terms of earnings and execution. That's where the focus will be, and the companies which do that will likely outperform. So give us a sense as to what that basket will comprise of.
Okay. Coming to the four-wheelers, Maruti is outdoing almost everyone in the market. What our channel checks are suggesting is Maruti is basically facing stockouts when it comes to inventory. So sales is extremely strong. We personally believe this time around the festive season will extend all the way till December. I think there is a booking pipeline of almost 4.25 lakh cars which are there. That is a booking pipeline that they have. Normally, maybe 40-50% of that gets converted, but usually in the festive season, 70 to 80% of the booking pipeline actually gets converted to actual sales. So you're looking at almost 3 to 3.25 lakhs kind of cars getting sold. So phenomenal. This year, definitely Maruti should give you high single digit kind of growth. We are very positive on Maruti. We would suggest investors stay positive on that. The other four-wheeler company which will do well would be basically Mahindra and Mahindra. I think we started the year with 7% kind of tractor volume growth for Mahindra and Mahindra. That got revised up after GST got implemented to 15%. We will be not too surprised if tractor volume growth in the current year is upwards of 20%. Now, when it comes to UVs, slightly more tricky because they are in the middle of their new model launch cycle. So, for example, they've just launched the Bolero and the response is quite good. Now, the next vehicle which they're going to, the new version of the vehicle which they're going to launch is basically the XUV 700. So, you will see numbers meaningfully going up for Mahindra from January onwards. So, in four-wheelers, we would say Maruti and Mahindra are our two top picks. Coming to two-wheelers, the two companies which are basically outperforming the market are basically Hero and TVS. Both of them are gaining market share. Hero, especially on the electric scooter side. So, for Hero, for the current year, we are expecting something like 12 to 13% kind of volume growth. For TVS, we are expecting 15 to 16% kind of volume growth. Again, Hero and TVS would be the two companies I like on the two-wheeler side. If I have to put it in a pecking order kind of a order, I think the best pick would be Maruti, followed by Hero, followed by Mahindra, and followed by TVS. I would insist and I would thumb the table and tell investors that go ahead, buy more auto.
Hospitality, Venkatesh, because that's one pocket which has seen again a tremendous tailwind. So one, we've spoken about auto, of course, and then within the discretionary space, is hospitality something which is on your radar? Is this a multi-year kind of tailwind that you're seeing in terms of consumption?
See, when it comes to, yes, consumption is strong and there has been gross underinvestment when it comes to hotel infrastructure in India. So while demand is growing at 8%, the supply is growing only at 5%. So we remain very positive on hotels. The problem with hotels is everyone is always scared when the new hotels will come online. So I would say that while you are looking at a multi-year opportunity, please keep re-evaluating the stocks and how many new hotels are coming online every 6 months and recalibrate your investments. At this point in time, the two hotel stocks which we really like are basically Leela, which got listed recently. We also like Ventive a lot. These are the two names which we like. Indian Hotels, ITC, these are slightly on the expensive side, so we are not really pushing those companies. So basically Leela and Ventive, these are the two names which we really like.
In fact, we actually do have numbers coming in from ITC hotels, wherein the consolidated revenue has seen an uptick of 8%. It's come in at 840 crores thereabouts. Consolidated profit, very healthy jump over year of 74% at 133 crores compared to 76 crores. You have EBITDA also that's gone up about 16%. EBITDA margins are looking healthy, about a 200 bips uptick at 29.3% compared to 27.3% on a year-on-year basis. But the stock has been flipping in the red and the green. I mean, we'll see what the reaction is. These numbers are not all that great, but they're not all that bad either. So it's a little bit of a growth coming in their overall numbers. But Mr. Balasubramaniam, coming back to you, I wanted to get your sense on the entire primary market and the exuberance that we've been seeing over there. Lots of new paper in the market and some marquee IPOs as well. Anything that looked good to you or anything that you have newly invested in?
I mean, as the head of research, I can't really invest in
Sure.
some of these IPOs, as you know. But LG Electronics at the IPO price, it was very interesting. But wherever there is an opportunity, it usually gets re-rated very fast. See, the number of IPOs also give you a clear indication that the market is expensive. The number of IPOs, the number of block trades which are happening, promoters are selling, private equity is selling, IPOs are happening. Clearly, there must be a reason for that, right? That they are all getting to cash out at the right price. So clearly, the market is expensive. I recently remember, maybe a couple of weeks back, when for the first time I saw 3 IPO advertisements back to back on the front page of a business newspaper. I have never seen that in my career before. So clearly, market looks overheated. Promoters are selling, private equity is selling, and also what you're seeing is FII, you are seeing selling in the secondary market. They're obviously subscribing in a lot of these primary issues. But yes, I think this is all getting facilitated by the fact that mutual funds are getting very strong inflows. So they keep the market supported at these levels.
I'll tell you where private equity is actually buying, and private equity in public markets is buying, which is the financials. You seem to be bearish. Talk us through what you believe or why you're apprehensive.
See, it's like this. We've been underweight on financials because, see, it's like this. We thought that after the correction in the market from September till say March, the market's texture will change. Last 10 odd years, India has been basically a growth market. So we thought at least this correction will bring some semblance. People will start looking at value. The only value sector was basically banks, where stocks were, private sector banks were trading at in line with mean, and when it comes to government banks, they were trading one standard deviation below mean. So we actually had a thought process that maybe this was a time for banks because they look very cheap. But we were proven wrong within a space of maybe 2 to 3 months, because we realized that in the India market, at least in the recent past, nothing works other than growth. And you have basically don't have too much EPS growth in the current year when it comes to banks. Now, given that NIMs have bottomed out, and when it comes to loan growth has also been slightly better than expectation, there is a temptation that we are thinking about maybe bringing down our underweight on the sector. But we have taken a call at this point in time. Let's wait for the entire earnings season to get over and maybe take a call after November 15th. So let me put it this way. I was a little more negative before the earnings season started. I have incrementally become less negative on the banks and financial side.
That is some share of positivity coming in for the entire banking and financial space. On that note, we'll slip into a very short